Elsewhere in Russia, President Vladimir Putin has warned that it could halt the remaining gas supplies to Europe, noting that new and potentially more profitable markets are emerging for Russian energy. His remarks come as tension in the Middle East disrupt energy production and shipping routes across the region. Recent military strikes involving the United States and Israel targeting Iran, developments that have unsettled global oil and gas markets, leading to a surge in prices. Analysts say the instability has tightened supply and increased competition among countries seeking alternative energy sources. Since the conflict began, European gas futures have climbed by more than 60%, raising concerns among leaders across the European Union about possible economic impact. However, European officials insist the bloc will continue efforts to reduce dependence on Russian energy, a policy adopted after Moscow's invasion of Ukraine. Right now, an oil and gas technologist, a person of Bolarinwa Durojaiye, and finance expert Muktar Mohammed both join me right now on the news for some insights on the economic impact of the war in Iran. Gentlemen, thank you so much for joining us. I'm going to start with you, Mr. Durojaiye. Now, with tensions around Iran threatening oil supply routes like, of course, the Strait of Hormuz, how significant could the disruption be to global crude supply, and what role could alternative producers like Nigeria play in filling that gap?
Yeah, thanks for having me. The disruption is already happening. The markets have probably not fully priced it in because there's this kind of sense, or hope, shall we call it, that the tensions would be short-lived and not necessarily extended. But if you watch the rhetoric of Iran and their actions and their posture, we don't seem to be seeing any de-escalation on the horizon. And as such, the impact on crude oil prices is expected to be quite significant. I mean, like we all know, you're talking about 20% of global supplies here essentially stuck and unable to get to the market. So we're looking at quite significant impact in the short term. I believe you will probably see that reflected in the markets tomorrow morning. Yeah.
Mr. Mohammed, with oil prices rising due to the Iran conflict, what immediate fiscal benefits could Nigeria see in terms of the export revenue, foreign exchange inflows, and even government earnings?
I think that is a no-brainer. We'll begin to see those physical effects on the government revenue because, again, you'll see oil benchmark, budget benchmark was about $60 per barrel. Even I think about $65 per barrel. Even if some of us felt that they should take it a little bit lower. No, sorry, I think it's $70 per barrel, and we thought they should take it a little bit lower. And now we've seen that hitting about $93 per barrel. So that already tells you that there's a lot of revenue coming into government in terms of physical revenue. And in terms of FX, of course, that also will drive in FX into the Nigerian economy, which will also help in stabilizing our exchange rate, which have performed very well since the beginning of this year, even if we are now gradually seeing a point whereby the FX rate is beginning to moderate again, going back to 1,400. But we could see that coming back to that 1,350 or ending the year on a high. And also, but again, these are also tied to other variables. We must improve our OPEC output that we've not been able to do for many years. So what could be a huge benefit to the Nigerian economy might not be we will still have those benefits, but we might not be able to have it because of our output, which is due to oil theft that is happening in some of this oil producing area. But in terms of revenue, I think the government would definitely have a good revenue output, especially also be able to build that sovereign wealth fund that we've not been able to build over the years, because what happened is that the difference between the budgetary price and the current price, what will be used for savings. So that could also boost our sovereign wealth, which has been in an all-time low. So it's good news for government in terms of the physical side and the revenue, and also stabilizing our exchange rate.
Mr. Mohammed, you mentioned Nigeria's production as probably an issue, and this now brings me to my next question, which I'll be asking you, Mr. Durojaiye. Now, higher crude prices, are often benefits, to oil exporting countries like Nigeria. But in Nigeria's case, our production has struggled with issues with theft and infrastructure challenges. From a technical standpoint, do you think Nigeria actually can, ramp up production quickly enough to actually take advantage of this price surge?
It's a good question. Again, all of that is dependent on what we're looking at in terms of how long this will last. If you're looking at, for instance, the next 1 or 2 weeks, there's really no magic you can do. For producers who have what you call spare capacity, which is either constrained because of OPEC quotas or whatever reason, they can open up their taps, essentially, and open up those valves and benefit from this. Nigeria does not have spare capacity in that sense. We're just a bit shy of the OPEC quota before all of this started, just almost 1.5 million barrels of oil per day. So if you're looking at a 1 or 2 week horizon, there's no magic that can happen in terms of ramping up production. However, depending again on how long this lasts, if it is drawn out and you start to look at 2-3 months of tensions and elevated crude oil prices, then that's a different picture. Not markedly different, okay, but different enough to perhaps incentivize, especially some of the indigenous producers who have shown a lot of promise in unlocking value from assets, brownfield assets that have not been as efficiently enough managed by the previous owners. We all, are aware of the news with Seplat and what they reported to have done with some of the old wells from the people they bought the asset from. So in that kind of 2-3 month horizon, we can see perhaps accelerated activity and incentivized by higher prices for a marginal increase in production. But in terms of being able to benefit fully from the upside, we are not really positioned for that in that regard.
Let me come back to you, Mr. Mohammed. While higher oil prices can, of course, strengthen Nigeria's foreign exchange position, analysts also warn about capital flight during a geopolitical crisis. Now, could global financial volatility, offset some of these economic gains for Nigeria? Mr. Mohammed, I'm not sure. Okay, let me come back to you now, Mr. Bolarinwa Durojaiye. It looks like we've lost contact with Mr. Mohammed. Now, if the conflict persists, right, and the global oil prices stay elevated, what opportunities could this create for Nigeria's, upstream sector, especially in terms of investments, drilling activity, and most importantly, production capacity?
Good. My response to that would be that the trajectory is already good. I mean, we've seen the final investment decisions that have been taken to a substantial degree in the latter part of last year. Quite a lot of money being voted essentially to the exploration and the development of offshore fields. We will obviously see more appetite for that if this crisis persists for longer. Also, don't forget that this is not just an oil crisis, it's a gas crisis, and a lot of the exposed markets now who are constrained in their ability to access gas because of the Straits of Hormuz blockage, are beginning to kind of reprice and rejig their risk management frameworks. Countries like Nigeria, which, as you know, is actually richer in gas than in oil, these are the things that determine what the investment outlook looks like, and it makes it a more positive outlook. It's, we will probably start to see more of those inflows to unlock some of our gas resources, potentially to supply their markets. Essentially, they will redirect capital to us. It's quite likely we will see that. And that's good for the development of the upstream industry. It's a lot of value to be unlocked, especially with gas. Yeah.
All right, I hear now that we can now reconnect with Mr. Mohammed. Mr. Mohammed, if you can hear me, I asked earlier, while higher oil prices can strengthen Nigeria's foreign exchange position, analysts also warn about capital flight during geopolitical crisis. Could global financial volatility offset some of these economic gains for Nigeria?
Well, again, we're an oil-driven economy, so definitely when you talk about global financial flight, in terms of us, when we see global financial flight, it's always as a result of low oil price due to things beyond our control. So you begin to look at investors, especially foreign investors, trying to flee the country.
Well, it looks like we've lost contact yet again with Mr. Mohammed. I'm just going to keep, of course, having a conversation with Mr. Durojaiye. Now, Mr. Durojaiye, despite being a major crude exporter, of course, we know that about Nigeria, Nigeria still imports refined fuel. So, technically speaking, how could the country lose out on the benefits of high oil prices if refining capacity and infrastructure challenges are not fully addressed?
It's a good question, and I mean, you are the news, or we listen to the news every day. In terms of the Dangote refinery capacity, and ability to supply the domestic market in full, the jury is still out on that. But the feelers we get is that this capacity is inching upwards. And obviously this helps us in the sense that the only thing we need to grapple with, I mean, pump prices will still go up, because his feedstock is the same crude oil prices, that are going up. But in terms of full exposure, to the dynamics of the international market, we will be a bit sheltered from that. To the extent that we are not able to meet all domestic demand with domestic refining capacity, we will have exposure there. It's just the way markets work. But again, the jury is out in terms of how much we actually need to import to meet the domestic demand as of today. But let's watch and see.
All right, like you said, let's watch and see. But then again, looking beyond the short-term windfall from higher oil prices, what do you think are the long-term financial risks for Nigeria if the conflict slows global economic growth and eventually weakens demand for crude oil?
If the conflict extends much further, it's not likely to weaken demand for crude oil. As a matter of fact, it will increase demand for crude oil, and that in effect will move prices upwards. Now, sustained extremely high crude oil prices do pose the risk of slowing, economic growth across the globe. I mean, it's a lucky thing with the gas shortages we're talking about now. It's a lucky thing that we're just coming out of the colder season here in the West, so that impact of cold winter and expensive energy is going to be reduced. But generally speaking, sustained high energy prices across the globe will slow economic growth. In regard to Nigeria, the truth of the matter is that it will help us fiscally, like my colleague just mentioned. We will enjoy more inflows. We will have call it a surplus in terms of the budget benchmark. And there is the potential, for us to use that well. One of the risks we need to be careful about is, and you can see what the CBN purportedly is doing with kind of managing the rate at which the Naira appreciates. I mean, we all want the Naira to appreciate, but you see that they're trying to manage it carefully, so that we don't have Dutch disease all over again, which happens when your currency appreciates, too quickly and does not reflect fully your full posture and position in terms of diversified exports and structural strength. So these are the risks we need to be careful about. We will get money. We need to use the money wisely. We need to manage our current exchange position wisely also. Pretty much those are the things we need to be careful about.
All right, I hear that we've been able to reestablish contact with Mr. Mohammed. If you can hear me, Mr. Mohammed, Nigeria's economy has historically been sensitive to oil price swings. Could a prolonged Middle East war create inflationary, pressure domestically, especially through higher fuel and transportation costs?
It's all right.
All right, we apologize. We're not able to establish contact with Mr. Mohammed. But gentlemen, thank you so much for having this conversation with us right here on News Now.